Hi team, it's Cam at Premier Property, and it's that time of the week when we have the Q&A live. So we are having this right now, and some fantastic questions that have been coming in from our Premier Property Inner Circle members. If you're watching this on YouTube, well, you're welcome. And if you've got any questions that you would like answering, then feel free to comment below and ask the questions, and I'll do my best to help you with this and help you to move forward in your property investing career. Whether you are new to property or whether you're absolutely experienced in property, doesn't really matter. Wherever you are, absolutely ready to help you. Now, if you're joining me for the first time, my name is Cam Devedi. Like what I say, I'm the founder of Premier Property, and I'm an investor developer over the last 29 years. And because of this, I train people and I help people with questions so that you can move forward on an entrepreneur level. So the first question I've got here is from Sian. So Sian is asking what sort of insurance needs to be in place for service accommodation, rent to rent. Thank you, says Sian. Sian, to answer your question directly, so in terms of insurance, there are three types of insurance that we have in place at Premier Property for service accommodation portfolios. So the first type of insurance that you really need is to make sure that your landlord, if you're doing a rent-to-rent strategy, that your landlord has building insurance. Absolutely important. You want to check in on this, and a good landlord will have that, of course. So that's number one. That is not really anything that you've got to do. That is a landlord having to do that, and you are just confirming it, ticking the box so that you know that they've got that. Now, that is for the fabric of the building. God forbid, if I'm allowed to say this, if anything happens to that building, if anything happens to the fabric of the building, that is the landlord's responsibility, and you want to make sure that insurance is in place. It's an annual insurance, normally not too much, depending on where it is and what type of property it is. Typically for an apartment, let's say an apartment in London or in a growth city, in a larger city, you're looking at circa anywhere around £200 to £300. And if you are in that sort of figure for an apartment, and if you're in an area which is in a satellite town, then you're looking at about 30% less of that. Around a couple of £100 is where you are, in my experience. So hope that answers that one. And we do have some of our Premier Property Inner Circle members joining us here right now. So I just want to give them a shout out, if that's okay. Remember, if you're watching this on YouTube, this has been recorded live in our Premier Property Inner Circle Facebook group, which is our Premier Property community. It's a mentorship group, and we have Donald who's joined us. So hey Donald, good to see you here from the Isle of Man. And we have Renee. So Renee Hawkins is also here. So good to see you, Renee. And also joining us, who can I see here? Yeah, we've also absolutely. So got a number of people joining, and that's great. And you're here as well. So we're talking about service accommodation insurance, what you actually need. So the first one is a landlord, like I say, building insurance. The second insurance that you need, and we have this at Premier Property also, and that is public liability insurance. So just to make sure that if someone trips up over an iron or something untoward goes along like that, someone puts their finger in a socket, which they shouldn't do, but it happens by chance. All of these things are covered, right? So children, be making sure that if someone got their finger trapped in a door or something like that, all these hazards are covered. And of course, you've done your best to make sure your property is safe, but unfortunately things do happen like that. So that type of insurance will cover that. Your public liability insurance is important that you have this. And I would also add to this that you have a professional indemnity insurance. So this is the third type of insurance that you have, professional indemnity insurance. Now, to be fair, both of these parts of insurance are normally married into one policy. So your public liability insurance and your professional indemnity insurance. So if anybody was to sue you or anything like that, then that all comes into play. So your professional indemnity. So how much do you pay for these? So you're looking at, of course, it's going to vary across the country. Typically, for an apartment somewhere in or around a larger city, you're looking at, for both of those policies, anywhere between £400 to £600 is a fair figure for the year, which you renew on an annual basis. So that's kind of what you're looking at. You might get a little bit more of a cost-effective price than that, but that's to give you a good ballpark. It shouldn't be more than that, and keep the investment within that in that price, and you'll be absolutely fine. Sian, that's a really good question, really, belts and braces approach. So really good of you to ask that one, and look forward to your further questions. I know you're going to have some more. You always got that. You're always moving forward, and you always got questions, so that's absolutely fine. And remember, Premier Property Inner Circle team, if you've got any questions, I'll be answering these live every week. So just post into the Premier Property Inner Circle community. And if you're watching this on YouTube, feel free to subscribe, click on the bell icon to get the latest video that comes up, and just keep continuing building on your knowledge, right? Active knowledge in property, which is exactly what I'm aiming to do my best to share with you right now. So following this, the second question we got here is from Catherine. So Catherine is asking, does anyone have experience in buying land for developments? What do we need to look for when reviewing and comparing? Is it true that land price is normally 1/3 of the house price? Many thanks, says Catherine. I like your style. So looking at large deals, looking at land. So here's what we do at Premier Property. So we love development, especially where we are in the market right now. It's a very exciting time for developments, as long as you keep your head and you get the numbers right. So great question, by the way. So let me answer this directly for you. Now, when we look at land or properties with land on the side or at the back or at the front, properties with land, what we always do is we calibrate. We calibrate the potential of that, becoming a development, or it being within permitted development. If it's land itself, of course, that's not going to be permitted development, that's going to be a development. But if you have a property on a piece of land, it may be that there's a permitted development potential. So whether it's a permitted development potential or whether it's a development potential, we grade this between 1 and 10 at Premier Property. Now, 1 is the worst scenario. So 1 is where, let's say, for example, there's some greenbelt land and there's no chance of really getting any development on that, within a short time frame. So we would class that as a 1. And 10 would be where you've got full planning for the property. So you purchase the property with the full planning, or the land with the full planning, and that is a 10 for us. So we work at Premier Property within the realms of 8 and 10. So when we're assessing land, we want to make sure it's within 8 and 10, because otherwise it's just too speculative. It's like gambling. And what we don't want to do at Premier Property is definitely gamble, because trust me, making the money is the easy part. Now, if you're starting out new and you're watching this, you're thinking, well, what is Cam saying? Making money is the easy part. Trust me, yes, it is. You remember this when you make the money, and just following steps like this, you're gonna make money. It just happens, right? As long as you take action, follow the instructions, do the steps, make it your own, make it happen. You are gonna make money from this. And when you're in that position, of having money, or you are listening to this and you are already an experienced investor in a situation where you have that money, you know what I'm saying. It's about then holding on to that money. So at Premier Property, one thing that we don't do is gamble. We do take calculated risks. That's exactly what we do at Premier Property, and you can do this too. So my point is that you can calibrate between 1 and 10, and at Premier Property, we are looking at a strong 8 to 10. And 8 is a calculated estimate that you have a very sure chance of getting planning on the land, or planning on the land with the property on it, whichever way you're doing this. So what is an 8? So an 8 is a strong confirmation. So we want to know that within the last 18 months, that when you look at the planning council's sites, on the planning sites with the council, that there has been, there's actually been confirmation of what you're looking to do. So there's been planning applications that have been approved with land or other properties, stock that's actually been new builds. Exactly what you are wanting to do. You want to find that confirmation. Confirmation from 8 years, 10 years ago ain't going to be good enough. You want it to be current. So really look for 12 to 18 months, like what I say. So you're getting that. Secondly, you want to make sure that you have assessed this with an architect. You've you've assessed this with them, somebody who's a local person, somebody who's dealt with sites around that area, and you want to get a strong confirmation that positively, no one's really going to put their neck on the line and say 100% that you can get planning, but you want to be sure that they are very positive, that they are very confident that you can get planning. So that's the second thing that we assess. And the third thing we also look for is local, physical properties that have been built, or land. You're looking at land, so land that has actually been built up with stock on there, new built stock, and that's happened recently. So within that region, has that actually happened? That will also give you good confirmation. So we assess these three, put them all together, and make a calculated risk. So that's where the 8 stands for. Now, when you're working in the 8, like us at Premier Property, then you also want to make sure that you've got a back-end exit strategy. So what do you do if plan A doesn't work? What's your plan B? What's your plan C? So I would urge you really to have 3 plans: plan A, plan B, plan C. What are your 3 exits? Think about this. So you know that saying, hope for the best, plan for the worst. You've heard that saying. It's exactly that case. Of course, you're going to make it work because you're doing it correctly. And this way, you're not gambling. It's a calculated estimate, and you can absolutely make this work. Hope that makes sense. Okay, so that's the first part of your question. And the second part of Catherine's question here is all about asking, is it true that the land price is normally one third of the house price? So you may have heard this, right? One third. And I'm going to share with you my view at Premier Property and what we are actually doing. So just want to introduce some more guys and members of the team here. So we got Amita's joining us right now, so he's watching us here. Hi Amita, good to see you here. We've also got Hassan, so Hassan's joined us as well. Ivana's watching as well. So welcome, and welcome to the team. And if you're watching this, you know what you can do. You can subscribe right here, and you can click on that bell icon, and I'll keep sharing these. Hopefully you're making lots of good notes. And if you've got questions, like I mentioned earlier, just ask the question, and I will do my best to help you answer this. Now, my experience in terms of the one third approach, where 1/3 is the value of the land, 1/3 is the build cost, and 1/3 is a profit, is that it's skewed depending on where you are in the country. So we are at Premier Property, we have 3 investment areas. So we have London, we also have around London, so the M25 and satellite towns around the M25, and also we invest in the Midlands, north of Watford as well. And they are specifically completely different areas. They're like completely different countries, it feels like sometimes. The whole scenario is completely different. So my experience in this is that if you're in areas like London, you might find it's not actually a third. It's more like 50%, 25 and 25. So 50% can be the land value because it's a higher priced value for the land, more prominent location, larger cities. So you may find this. And your build costs are around 25%, 25 to 30% to be fair. So it's more like 50, 30, 20. And your 20% is your margin that you're going to be making in a high growth area. Now, the great thing about 20% is it's commercially accepted. So many lenders, in my experience, accept 20% as a good profit margin. So if you think about it, so we're doing a couple of projects right now. So one of them is a £2 million project in Deptford in London. And that £2 million project, the end value is exactly like I'm sharing with you. We're going to make a 20% margin on there. So, we're making a sort of a circa £500,000 plus profit on that. So 400,000 to £500,000, which is absolutely, they're great numbers. If you think about it in reality, £400,000, pretty cool. So these work. So if you're in large cities, you can get to these numbers. Now, you can buy these lands. If you're watching this, and this is a question that's being asked here by Catherine, and but you could be buying these. But remember, if you're watching this right now, you're thinking, well, yeah, that's a great amount of money. That's something you aspire to. How the heck do you get into that? Keep in mind that I started with nothing. And you can actually be sourcing these properties as well. So one thing is you buy them. Another thing is somebody else buys them. If you're following me here right now. So you buy them, someone else buys them, but there's a buying process. So you can actually be finding these properties for other people, sourcing them. And as you're sourcing these properties, you will get paid for these. So keep this in mind. So it doesn't have to be always your money. It can be other people's money as well. There's joint ventures. So many ways that you can do this. And the point is that you can make money from something like this, land and developing and so on. So keep that in mind. In large cities, 50, 30, 20. 20% margin, commercially accepted, lenders like it, you can source it, investors will love it, you can make money from this. And outside of London or in satellite towns, what you'll actually find is that your margins change. So it's more like, actually 30% for the land, 50% for the build cost, and 20% for your profit margin again. And the reason that is because the end values of properties in satellite towns is going to be a lower value. So the ratio of the build cost is higher. So I say that one more time. So you've got 30% you're paying for the land, 50%, so the larger amount ends up being your build cost because the end values in comparable are going to be lower. But remember, the fixed cost for building the property is going to be more or less the same. And then your margin, you want it to be there, and that's, you're looking at a minimum of 20%. To be fair, at Premier Property, we only consider properties of this type, land of this type, where there is a minimum margin of 33%. So that's a choice. You can do it your way, but we want to buy good deals, and you can buy good deals. In fact, we're doing we're doing a couple of these right now. So there's the one that I mentioned, and we got another project which I'll be sharing with you on another video, where we're building 9 flats and a commercial unit, and that's 10 units, and again the margin is higher than 33%. So hopefully you're capturing all these numbers and you're getting the flavor of this. So that's an excellent question there. Thanks for starting all of that, Catherine. So I hope this helps. Hopefully you've got more than you bargained for. You got a lot of detail there. So yeah, absolutely, land works just like this. Brilliant question. Okay, so we're moving forward to the final question of the day for today. And this is a question that is being asked by Gabriel. So Gabriel is asking, so I'm going to read this out. Anyone came across buying a B&V property in the future regeneration area? Okay, so Gabriel's looking at buying a B&V property in a regeneration area that's gonna be a higher price point in the future. The building is going to be demolished in 2023. Okay, so got a little while yet, and the property is being sold for cash. And Gabriel's put here, banks do not provide mortgage due to future regeneration. And 70% of current market value, and it needs a refurbishment to increase the value. The council will be buying properties at market value plus 10% compensation, and will cover moves to stamp duty cost for the new property. Okay. Is this a good investment? Could this be a good investment? Is asking Gabriel. Interesting. So, there's many people out there that are looking at massive deals, 35, 50 plus units, massive schemes, and that's all great. What you got to remember is, it's great to dream. At Premier Property, we love also to dream. If you're like us, dream big, dream as much as you like, have that big vision, absolutely. But please, like us at Premier Property, also make it practical and make it achievable and make it doable for yourselves, with a stretch. So what is my point? Why am I saying all this? Well, these kind of projects, Gabriel, we are multimillionaires, or you might be building on your 50k income for the year, like I did. You can as well. Maybe then you step it up to 100k or a couple of 100,000, or maybe you're into the millions like us at Premier Property. That's all fine. But what we've got to keep in mind that we're not billionaires. So the strategies that we apply are strategies where they are financial freedom strategies for the short term. Short term meaning 1 year, 2 year, 3 year, in that sort of time frame. These kind of strategies that you're assessing here, Gabriel, right now, you're looking at 10 years plus. So that is a billionaire strategy. We don't have that luxury. But the luxury that we do have as multimillionaires, as people working on your fixed returns, all of us, I'm talking to the team here, your first 50K, your replacement of your income, whatever that might be, 25K, 50K, your first couple of 100,000, as I've just mentioned, or your millions like us, we're working, working within that remit. And yes, we're stretching. Yeah, we're stretching. And the thing is, let's make it practical and let's make it doable. So my view is something that you're looking at, which is 10 years plus in the vision, isn't really for us. What we want is something that we can do now. Projects like buy-to-lets, which we do a number of, and you can do a number of, anywhere between 4 or 6 on a monthly basis. HMOs, where we've got half a dozen or so HMOs working within 6 weeks or so on a constant basis. You can do these income producers, where what we find is, you can become financially free very quickly using income producing strategies like HMOs, houses of multiple occupancy. To be fair, you don't need a lot of those. 3 or 4 or 5 of properties of that type will help you to become financially free. And this is exactly what we've done at Premier Property and continue to do. So these types of strategies, or if you're looking at permitted developments or developments, in the region of £2 to £4 million is where we are at Premier, and the time frame is the most important. So that could be a couple of £100,000, it could be a couple of million, but the time frame needs to be 12 to 18 months. Because what are you going to do if the finance rules change, as they're constantly changing? What you're going to do, as we already know, we're heading towards a recession. So what we're going to do later on. So my point is, keep it to a time frame, keep it to what is achievable for you, but with a stretch. And 10 years plus is too far down the line. We want to be doing projects which you can complete within 6 weeks, or maximum 12 months to 18 months for larger projects. This way, your property investing will be safe, it will be secure, and you can really make this work. And you know what? In my experience, you don't really appreciate the small, continuous small things done really well. Those little diamond gems put together, which make a massive, lovely investment for you, until you've done the big. And when you've done the big, like us at Premier Property, you understand that actually, sometimes a number of smaller projects in a smaller timeline gets you more or less the same results sometimes. So you can go large and do big, or you can have a number of small increments, and whichever way you want to do it, you'll get results. And my suggestion is that you keep it to projects which are maximum 12 to 18 months. Thinking 10 years ahead on a project is not really feasible. And if you want proof of this, why are the lenders not lending on it? For exactly the same reason. Keep it professional, keep it moving forward. So we've got Binish joining us here as well. We've got Yvonne joining us. We've got Simi's here as well. So many of our team here. So hope you're enjoying this, and I'll say it for the final time in this video, subscribe, click the bell icon. It's Cam Dwighty at Premier Property, helping you to take your property investing to the next level. I look forward to seeing you on the next Q&A. Keep joining in, and I will see you there in 3, in 2, in 1. Bye for now.